Hey everyone, welcome back. Today, we're diving into a hot topic for investors, SPLG versus SPY. If you're eyeing the S&P 500 for your portfolio in 2025, you're probably wondering which of these ETFs is the better buy. Both track the same index, but small differences can make a big impact on your returns. Let's break it down step by step. First off, what's the S&P 500? It's a benchmark index of 500 large U.S. companies, representing the cream of the crop in the stock market. SPY, or the SPDR S&P 500 ETF Trust, is one of the oldest and most popular ways to invest in it. Launched in 1993, SPY has over $500 billion in assets and trades like a stock, making it super liquid for frequent buyers and sellers. On the other hand, SPLG is the SPDR Portfolio S&P 500 ETF, a newer kid on the block from 2017. It's designed to be a low-cost alternative to SPY. Let's compare the key factors. Expense ratios are huge here. SPY charges about 0.09% annually, while SPLG is even cheaper at just 0.02%. That means over time, SPLG could save you money on fees, especially if you're holding for the long haul toward 2025. Performance-wise, both ETFs closely mirror the S&P 500, but SPLG has a slight edge in tracking accuracy due to its structure. Dividend yields are similar, with SPY offering a bit more liquidity for day traders. However, if you're focused on minimizing costs and maximizing returns by 2025, SPLG might be the winner for most passive investors. Of course, market conditions in 2025 could shift things. Think potential economic growth or inflation. Always consider your own financial situation. My advice? If you're a buy and hold investor, go with SPLG for its low fees. But if you trade often, SPY's liquidity is unbeatable. Remember, this isn't personalized advice. Consult a financial advisor before investing. Thanks for watching. Hit that like button and subscribe for more investment tips. See you next time.